Joining me now in studio is Eugene Barbaneagra from SEI Investments. Now, he will assist us with the discussion on the topic with regard to the importance of risk management within the context of global investing. Eugene, very good to have you with us today. Just judging by the introduction, it sounds like a very heavy topic, and I take it people at home are thinking, oh, how's boring. This one going to fare? But it's not boring, and that's the point. You're going to teach us that today, Eugene. I want us to obviously paint a picture of the current economic environment and obviously how difficult it is to actually manage and mitigate against the risks presented.
Well, yes, from one perspective, the world has become a much more globalized place. So the factors affecting the US, the UK, the Japan market are obviously felt at home, as your previous guest Wayne just mentioned. South African equity market is not about ESCOM necessarily, it's about the rest of the world. Yeah. I must fully agree with that. And today the hot topic is the long yields in the US. Are they going up? Are they going down? Are they too expensive? Are they too low? So everybody's trying to guess that, and as those guesses are changing, obviously that creates a lot of volatility in the market at the moment.
Maybe if you could walk us through that, because that big V word, I've been hearing it every day this week and even longer. But in such a tough environment, then where do you identify opportunities of value? Is it in the equity space where there's just ongoing liquidity and free cash, or slight opportunities in the bond market where we've seen a slight turnaround there?
In general, we find some opportunities in there on the lower credit spectrum in the U.S. high-yield market, where probably over the last 6 months there was a lot of turmoil in the energy market and created a lot of stock picking opportunities, actually, the bond opportunities. But in general, bonds are expensive. We find them expensive across the world. Again, I would agree with your colleague. However, it's hard to say that equities are cheap. So the only rationale to stay in equities is to say that bonds are more expensive. Then equities, the only way we can justify equity valuation today is if we seek inflation protection. Equities are supposed to give us better inflation protection than bonds, which will not give any inflation protection. So if you are afraid of inflation, probably equities is a good place. If you're afraid of deflation, which, by the way, people always talk about inflation, particularly in emerging markets, because this is what we are used to in the faster growing parts of the world. But in places like Japan have experienced deflation over 10, 20 years. So this is not something to disregard. And yes, quantitative easing in Europe is supposed to alleviate the problem. But again, it will not necessarily work. Japan is a good example. One may throw enough money at it and still get nothing back. And from that perspective, perhaps bonds are not that expensive. What I'm trying to say is everything is easy in hindsight, but on the forward-looking perspective, the economies and the markets and the politicians will surely throw something at us which we are not able to foresee today. And maybe from that perspective, just pure diversification does make sense.
Pure diversification. It is clearly the #1 rule when it does come to investing. But #2, also a very difficult one. And maybe if you can walk us through the dynamic of allocation when you're trying to reach your alpha, but also manage and mitigate against this risk.
Well, I think first of all, very basic principle of you spread your risk across different markets. And even if you don't chase the return, if the idea to get out of your local market or for your comfort zone, not to achieve a high return, but to mitigate the risk, that makes sense. Just to give you one example, if you think about the US market, it's more technology-driven, more information technology, the Facebooks of the world, Teslas of the world. If you think about, obviously, South Africa, Canada, Australia, a lot of the resource economies. If you think about Europe, it's more old economies, consumer staples, maybe some of the industrials.
Yes.
And markets, economies sometimes go through very long cycles, 10-year, 20-year cycles, when one part of the market is favored over the other part of the market. And it's very difficult to foresee in advance. So purely diversifying those forces makes sense. There is currency exposure. Of course, currencies depend on the money flows, also depends on the current account balance. So for a South African investor, being exposed to the European currency or to the US currency also offers diversification. And finally, just basic stock specifics. If you are investing in the US, you can buy Tesla, you can buy Facebook, you can buy Amazon, which is just not available in the UK market, for example, likewise in the South African market. So you just have great opportunity set, which in theory should provide you more alpha opportunities.
Mm-hmm. So the benefits obviously are what you're alluding to there. I want to come to your visit to South Africa, Eugenia. You mentioned that it's not the first time that you've been in the country, but when you go back and speak to your colleagues abroad, what key questions do they ask you about our economy? Are they finding opportunities in South Africa and maybe plowing their money here?
Well, the question they always ask is, where's the gold going? This is the only thing people are interested about.
We don't even know that.
Well, of course, nobody knows that. So, yes, but in terms of opportunity, in terms of investing, it's, in general, my colleagues and I, we find resource-dependent economies challenging to invest at the moment.
Especially in the current commodity cycle.
Yes, yes. We find that the last 10, 15 years were facilitated by the Chinese growth, and we find that the next stage of Chinese growth is unlikely to be the same as the last 10 years. So the extrapolation, yes, miners are cheap on the current earnings, but there is a chance that they will continue being cheap and even cheaper. There is also, of course, if one expects rising yields in the US, one should expect strengthening dollar. If one expects strengthening dollar, then one should expect weaker commodity prices. Yeah. So if I close the loop, it's quite challenging for not just the commodity, not just for the stocks, but also for the economies, given how much of the local GDP, how much of the consumer locally is dependent on their high commodity prices.